Hey everyone, Adil here, and welcome to the February edition of the Surroundup. Today I'm going to switch gears from my usual market and investment-driven ideas and instead focus on something we can control, ourselves and our behavior. That said, we recently hosted a webcast with Drummond Brodeur, Senior VP, Portfolio Manager, and Global Strategist at CI Investments. He provided insight into what's happening in the markets and shared his thoughts on the future. If you didn't catch that webcast and you'd like to see it, we did record it. So please let us know and we'll be happy to email you the link. Okay, so back to what we can control, our behavior. Remember, you can have the best wealth plan, the perfect asset allocation, and the greatest portfolio managers, but it's all for nothing if you cannot manage your behavior. JP Morgan puts out a chart every quarter that shows the return each asset class has achieved in the preceding 20 years. Take a look at this chart, which shows the period 2001 to 2020. Do you see that orange bar? That's what the average investor earned in that period, 2.9%. Almost every asset class, real estate, bonds, small cap, emerging markets, you name it, earned more than the average investor. This chart basically says you can buy and hold almost anything and you will outperform the average investor. How can that be? How can an investor have worse performance than the markets they are invested in? It's because human beings are predictably irrational and in many cases make investment decisions based on biases and emotion. Here's another famous study, the Dalbar study. In financial services, Dalbar is one of the leading market research firms in the US. Each year since 1994, they have measured the effects of investment decisions to buy, sell, and switch into and out of mutual funds. Their most recent study shows that over a 30-year period through 2019, the average equity fund investor earned just 5% on average per year, which is half of what the market earned over the same period. Why? Because investors were trying to time the market, which we know is impossible, and were switching investments along the way. And perhaps you've seen the sketches of Carl Richards, creator of The Behavior Gap and writer for the New York Times. Here is his sketch on investor returns versus investment returns. Humans being predictably irrational and too often making investment decisions based on biases and emotion can lead them to sell on the way down and buy late into a rally. Here's another one of Carl's great sketches that makes that point incredibly well. To be clear, I'm not saying you're the average investor, or that you're personally guilty of trying to time the market, or that you're making irrational decisions based on emotion. Our clients have built tremendously strong habits of trusting the process and investing for the long term. And hopefully, you've seen the fruits of this labor. I just want to remind you, at a time when market volatility has returned, that your behavior and biases can have a tremendous effect on your outcome. So the big question is, how can you continue to effectively manage your investment behavior? First, you need to identify and understand the various biases. Today, I will touch on one of them, action bias, which is the tendency to favor action over inaction. Here's a great example. Think about penalty shots in soccer. The soccer ball is being kicked so hard from so close that the goalie has to decide whether to jump left or jump right or stay in the center before the ball is even kicked. An analysis was done of 286 penalty kicks in top leagues and championships worldwide. It shows that given the probability distribution of penalty kick direction, the optimal strategy for goalkeepers is to stay in the goal center. But in a penalty shot situation, goalies almost always jump left or right. Why? One theory is that the goalies have an action bias. If they jump left or right and don't stop the ball, they don't feel that bad because they took action. If they stand in the center and don't stop the ball, they feel a lot worse because it can be argued they did nothing. The same can be said about investors and the market. When we go through a challenging period, it may feel better to take action, dive left or right, to change course or abort the plan. But in many cases, if you trust the philosophy and process, your best move, and arguably the most difficult one, is to simply stay the course. That's it for this month's Surroundup. If you have any questions at all, please reach out. And until next time, always remember, there's more than one way to wealth.